with my friend Rocco Ward, and today we're going to talk about blended interest rates.
Yeah. So, Joey, tell me, what's the biggest objection you're seeing from clients and from realtors concerning the higher rates we have right now?
Obviously, rates are at a near high, so why would someone want to trade in maybe their 3% interest rate they locked in a few years ago and get into a mortgage at interest rates at 6 or maybe 7% interest? So if we take that question one step further and look at their total liabilities or their total debt, we can talk about what's their blended rate of interest, and we may be able to come up with a solution that better fits their needs.
Okay. So with that in mind, we have a client who's just sold their home. They have a large chunk of equity/cash. What should they do with that money?
Great question, Rocco. So I think the first step is have a consultation. We'll take a look and see where they're at. Debt is at a near 5-year high for Americans, with savings being at a near 5-year low. So let's take a look at some of these facts. The number of Americans with more than $50,000 in credit card debt has doubled since 2019. The average APR offered on a new credit card today is over 24%. The average federal student loan debt is over $37,000 per borrower. And here's the one that really gets me. The average car payment has doubled in 3 years to $800 a month, with 17% of Americans paying over $1,000 a month on their car loan.
Okay. So this is some good data, and I'm hearing you, but I really want to see it, Joe. What can you show me?
Yeah, let's take a look at that blended rate calculator. Here on this screen, the question is, do you really have a 3% rate? And that may be true on your mortgage, but when you add in credit cards, car debt, other debts, in this scenario, they have Visa, MasterCard, Discover, Macy's, Nordstrom. For 411,000 total debt, you add all those, or you blend those rates together, you've got a rate of 6.33%, which is nearly where mortgage rates are today. So let's kind of dive into a more specific example. Let's take a situation where someone had a 3% interest rate. 5 years ago, they bought a house for $500,000. They put $100,000 down, and they want to buy a home today, and today's rate's 6.75%. So if they sold that home for $695,000 after paying off their balance, their closing costs, they're going to have about $305,000 left over to put towards a home. In a traditional situation where they just take all of that money and apply it towards the purchase price, they would have a $545,000 loan. And with the higher interest rates today, that's going to increase their monthly payment nearly $2,600. So you can see why buyers would be reluctant to give up that 3% interest rate for something at 6.75. But let's look at the strategy of maybe consolidating some of that debt, paying that off. So you have credit cards, a car loan, maybe $100,000 of consumer debt. If we pay that down first and then put the remaining towards the balance, we're going to take this monthly deficit of nearly $2,600, and that goes down to $286 by paying off all of that debt. So not only are we improving their blended rate of interest, we're also improving their cash flow to put them in a better financial situation. This person traded a $500,000 house 6 years ago for an $850,000 house today for only $300 more per month out of their budget. So Rocco, with that information in mind, what should someone do?
Yeah, Joe, that's really good information. So if you want to help your clients with this, really what they should do is reach out to me or Joe or any of your favorite AMC loan officers. We're all a team here.
Yep.
We really want to find the best custom debt strategy for their needs.
Absolutely. So I hope this information helps with your conversations with the people in your COI that you're talking to. If you guys have any other questions, please feel free to reach out.
Thank you.
Thanks again.